Hi everybody, Jeff Yasteen here. If there's any single lesson that I could boil down in my years as an investor and a former financial journalist, here it is. Wall Street reserves the right to change its mind and not tell you about it. That's why I think it's about to part ways with one of the favorite stocks of the past decade, Microsoft. It's also why Microsoft stock, which is trading just below its all-time highs, remains an ideal short sale in my opinion. As I noted in my original New Year's prediction on this, there's no question that the company is firing on all cylinders with steady profit growth. The stock is highly touted. As a result, it's owned by most of the big hedge funds. It's at the top of everyone's buy list and on the lips of every strategist on CNBC. Out of roughly 24 firms with published opinions on Microsoft stock, 22 rate it the equivalent of a buy or a strong buy. All but 2 of those, basically, 22 out of 24. And you know what? It doesn't matter. When institutional traders decide that a favorite stock has reached its zenith, they've already got one foot out the door, but they have one last problem. They need buyers. They need to convince someone else to take the other side of the trade. And that's where retail investors like you and I come in. We're supposed to be the poker game patsies, the rubes who fall for their sleight of hand shell game. And perhaps this chart, which shows us Microsoft's sky-high price-earnings ratio, may keep you from falling into their trap. A price-earnings ratio simply tells us how much we're paying to own a company's shares relative to its profits. Microsoft's PE ratio is over 30. And it wasn't that long ago that it was actually much lower. A PE ratio is also a measure of a stock's popularity. The more optimistic investors feel about a company's prospects, the more likely they are to pay a higher price to own a share of those profits. In Microsoft's case, the last time the company was this popular with a PE ratio of 30 or higher was back in 1999 and early 2000. I don't need to tell you what happened next. So don't get me wrong, Microsoft's profits, they're still growing. Analysts expect the company to earn about $5.69 a share this year, rising to around $6.20 a share next year, and $7.19 a share in 2022. That works out to growth of around 13% a year. But Microsoft's PE ratio implies that investors expect the company to grow its profits at a 30% annual pace. Now, that's an unsustainable situation in my opinion. And you know what, while we're at it, let's do a little technical analysis of Microsoft's stock chart as well, because I think that's an important demonstration also of where the setup for this stock, I think, looks like a really good short sell. And if we go and look at the chart here, you'll see, what's this called? It's called the double top, or at least that's the direction it's certainly looking. Now, obviously, with any kind of technical analysis, just like fundamental analysis, none of it works all the time. That's just the truth of the matter. You can choose one or the other. You can do both. That's what I do. But the fact is, none of it's ever going to work 100% of the time. But I think in this case, Microsoft shares are giving us a clue. And the double top is that clue. You can see right here in basically late summer last year, the stock is trading in the high 130s, $140 a share, represents, a decent, okay value. It was trading at roughly 25 times its 2020 profits. And then, in the exuberance of stock investors, they bid the stock from 140 all the way up to almost 190, or actually for 1 or 2 days it got to $190 a share. Then the virus outbreak hit and the stock fell all the way down to basically the mid 130s. Once investors got a hold of themselves, this is the buy point where millions of new investors came in and bought this on the dip. And that's what sent the stock back up to the 180s where it is now. And that's my concern, because double tops like this are typical of a stock where there's a great deal of exuberance. People buy it the first time, there's a great deal of selling that drives it down, and then suddenly a lot of new people come in and say, let's buy this thing. And they're the last ones left to be holding the bag. That's my big concern right now. If you're an investor, but also again, if you're somebody looking to do a short sale, this would be a place and the kind of formation you might want to look. Now, could I be wrong? Absolutely, I could be wrong. If you look back on Microsoft's stock chart at other periods of time, you can see plenty of other situations where it appeared that the stock might be going on to a double top of some kind. This might have been one right here back in 2018. And you can see other examples where, again, they were what technical analysts would call, broken double tops that did not work out. And again, that's just part and parcel of the game. But if we go all the way back, it'll take me just a moment. This is this right here is the peak of Microsoft stock back starting from 1998 to 1999, right here where my cursor is. And this right here is January of 2000. That was the last time that Microsoft stock, until now, to the last handful of months, traded at a PE level of 30 or higher. Now, the thing about growth rates, profit growth rates, is that there is sort of a limitation for companies as far as how high their growth can go. The bigger a company gets, the harder it is for its profits to grow at 30 or 40% a year like it might have done in its earlier days when it was just much smaller. And that's certainly the case. And that's the big challenge for any big company, or let's say a small company that grows into a big company, is trying to continue its growth rate, its profit growth, at some level approaching what it was when it was a smaller company. And that is very, very hard for companies to do. Eventually, the stock comes down. That reflects the lower expectations of profit growth. And that becomes sort of the new normal for the stock. And that's something we certainly saw with Microsoft shares through basically the bottom of the dot-com bust, which is for the broader NASDAQ, was right around here, 2002, early 2003. You can see Microsoft stock, it really went sideways for the entire first decade of the 2000s. And it didn't really find its ultimate bottom until 2009, March 2009, which, as we all know, was the bottom for the sell-off after the financial crisis. And then obviously the full bull market took off from there. And Microsoft did. Microsoft shares went up with it. So that's where it stands right now. We have two major things going in favor if you're looking or expecting lower prices for Microsoft. Number one is it's at peak valuation relative to its profit growth. And number two, you have a very interesting looking technical analysis setup with this double top. And we'll see how it all pans out through the rest of this year. But I think things are looking very good and would expect the stock to move lower as we get through the tail end of the summer and on into the fall. One of two things is going to happen. Number one, Microsoft finds new ways to rapidly increase its annual profit growth, and perhaps investors are anticipating this. Perhaps its foray in recent years as a cloud computing competitor against Amazon, maybe that pays off in a big way. Or the stock share price falls back to a level that more closely matches its profit growth for the future. Now, I'm betting on number two, and that's why I think the stock makes a good short. I expect the share price to fall more than 30% to around $120 a share by the end of this year for starters. Now, why that price? Well, if we divide 120 by Microsoft's 2021 profits of $6.20 a share, well, that's the level where we get a PE ratio of 20. At that level, investors would still be paying a sizable premium to own the stock. But considering the last time Microsoft stock was this highly valued, they would not be paying that once in 20 years premium that Wall Street is demanding you pay right now. Make sure to keep liking us on social media. Subscribe to our Smart Profits Daily YouTube channel. I'm Jeff Yasteen, wishing you the best of goodbyes.